Cafe Ambience. Welcome to the first coffee by Alpha Root. Today is Thursday, April 30th, 2026. Dollar yen just swept the previous day's high of 160.47 and, well, it rejected hard.
Yeah, incredibly hard.
Right. And by the end of this briefing, you will know exactly which New York session setups have a verified edge today and which ones are just noise designed to chop you up.
Exactly. And, it is important to establish right at the opening bell that all the market data we are dissecting right now, it's drawn strictly from our preliminary morning scan.
Yeah, absolutely.
Our core mission on this desk today is to filter out the noise that's just flooding your feeds and really map out the precise structural risk levels. We want you stepping into the New York session, executing based on math, not emotion.
Coffee cup, math over emotion, always. And that execution edge, it starts immediately with our Tier 1 assets.
Yep.
These are the specific instruments where our models are registering a distinct, measurable operational edge for the New York session. So our active radar today features dollar yen, gold, eurodollar, dollar CAD, and dollar Swiss.
A really solid lineup today.
It is. And I want to unpack dollar yen first, because the anatomy of what happened in the overnight session is, it's just a textbook example of market mechanics.
Oh, 100%.
The London session expanded significantly, right?
Yep.
Just pushing price aggressively upward.
Right, and that heavy London expansion, that is the foundation of our entire thesis for New York today. Because of that aggressive push, the operational strategy for dollar yen today is a weight reversal scenario.
Meaning we are not just blindly chasing it.
Exactly. We are not looking for the trend to just keep running to the moon. The priority action for us is actually a sell.
A sell, okay.
Yeah. The base case is a measured reversal back into the core operating range of 159.47 to 160.47.
Let's talk about the psychology of that 160.47 level for a second. Think of it like a hot stove.
I love that analogy.
Right, because retail traders saw price racing toward that major high and likely assumed, oh wow, this is a massive breakout. So they hit the buy button, just piling in.
They always do.
They do. But instead of continuing, the market touched the stove, swept those breakout buyers, and immediately pulled back fast.
Yeah, the institutional order flow recognized there was just no liquidity up there to sustain the move, so they absorbed those retail buys to fill their own short positions.
It's brutal. And we are currently trading lower, around 158.22.
Yeah.
But here is where it gets tricky for the intraday trader,
Right.
Since our official posture is to wait, what is the actual danger of just hitting the bid right now? If we know it touched the stove and pulled back, why not just get positioned early and ride it down?
Well, getting positioned early is, quite frankly, the fastest way to blow through your daily risk limit.
Yeah, for sure.
It really comes down to understanding how algorithmic liquidity hunting works. Just because a key level was rejected once on a sweep, that does not mean the market algorithms won't circle back to test that liquidity pool there again.
And want to double check the stove.
Exactly. They want to see if any new institutional sellers step in. So if you jump the gun without structural confirmation, you aren't trading an edge. You are just gambling on a preliminary reaction.
Which is exactly why we rely on invalidation levels.
Yep. Sustained acceptance above 160.47 or breaking entirely below 159.47, that completely destroys the premise of this reversal setup.
And we should probably define sustained acceptance because it is a critical concept.
Oh, absolutely.
We are not talking about a volatile 5-minute wick that pierces the line and retreats.
No, a wick is just a test.
Right. Acceptance means time and volume are actually building outside of our established parameters. If price action parks itself above 160.47 and starts printing heavy volume, well, the narrative shifts entirely.
It really does. It is no longer a sweep at that point. It is an accumulation phase.
Exactly.
Which means the market has accepted that new price reality. If that happens, your short thesis is dead and, patience saves your capital.
Paper flip patience is everything. Now, this same mechanism of sweeping liquidity before a reversal, it is playing out beautifully on the eurodollar today, just in the opposite direction.
That's the exact same playbook, just flipped.
Yeah, eurodollar is also giving us a reversal play. The previous day's low of 1.1660 was swept in a classic stop run, and we're currently holding higher around 1.1705.
Right.
So the overall bias is bullish, but we're still locked in that weight reversal mode.
And before we map the specific parameters for that pair, just a quick reminder that this framework is built on our preliminary data. For eurodollar, the priority action today is a buy. The target is a reversal back into a very specific pocket of liquidity, which is the range between 1.1660 and 1.1720.
Okay.
The invalidation occurs with sustained acceptance outside that exact block.
So the tape shows steady committed volume printing above 1.1720, or if it dumps below 1.1660 and just builds base there, the trade is off the table.
Exactly. It's completely off the table.
You know, the symmetry in the market mechanics here is fascinating.
It really is.
On dollar-yen, the algorithm swept the highs to trap the breakout buyers, which sets up our sell priority. But on euro-dollar, they swept the lows to trap the breakdown sellers, setting up our buy priority.
Yeah. The direction biases are completely opposite, but the underlying operational protocol, waiting for the return to the established structural range, it's mathematically identical.
It really strips the anxiety out of the decision-making process.
Oh, 100%. You aren't guessing where the market might go. You are simply defining the box it needs to stay inside.
Right.
It forces the trader to respect the structural range rather than predicting some breakout that hasn't materialized on the tape yet.
Yeah.
We let the actual order flow dictate the execution.
Because if you try to front-run the market based on, say, how you feel about a central bank speech.
Oh, the algorithms will just use your position for exit liquidity.
Every single time.
This is a preliminary briefing. For the final validated 9.0 a.m. report, visit alpharoot.vercel.app.
Okay, so the market environment isn't solely defined by these reversal profiles today. We are seeing a distinct shift in momentum when we look at the continuation setups.
Yeah, there's definitely a gear shift happening there.
Gold, for instance, is operating in a vastly different structural context. It is currently sitting in heavy expansion mode, much like the yen did earlier, but the prescribed action is entirely different.
Right. Gold is highly active today, and the setup we are tracking is a weight trigger breakout.
A breakout this time, okay.
Yeah, what happened structurally is that during the London session, the order flow established a very firm support baseline at 4,540.9.
That's a solid floor.
It is. It absorbed a massive amount of selling pressure right there and held the line perfectly. So given the overarching bullish bias and a buy alpha rating that sits comfortably over 62% today, our priority action is to buy.
Right.
But exactly, the crucial caveat is that it remains a weight trigger scenario.
Right, so we are currently holding strong above 4,637. Let's really detail the risk mechanics here, because breakout scenarios, they are notorious for chopping up retail traders who don't understand invalidation.
They are meat grinders if you don't know your levels.
Absolutely. The base case for gold is a post-breakout continuation holding above 4,610.3.
Right.
This entire setup becomes invalid if we see sustained acceptance below that 4,610.3 line.
Yep, that's the line in the sand.
If the price falls back below that level and the volume profile flattens out, well, the bullish continuation thesis is dead for the active session.
Exactly. We only want to commit capital to a bullish continuation if the market actually proves it can sustain higher pricing.
Prove it first.
Right. If it drops back below 4,610.3, you are looking at a failed breakout.
Yeah.
And holding a long position there is just, it's hoping for a miracle.
And hope is not a strategy.
Never. Now, looking at the broader macro picture, we need to pivot to the heavy bearish tilts printing on the dollar crosses, specifically dollar CAD and dollar Swiss.
Okay, let's get into those.
Both of these pairs are registering as weight trigger breakdown setups, tightly aligned for bearish continuations.
I want to challenge this mapping for just a moment to ensure we really understand the risk correlations here.
Sure, go for it.
We have clear bearish breakdown setups on these dollar crosses, which translates to looking for a weaker dollar against the loonie and the Swiss franc.
Correct.
But over on gold, we just outlined a fundamentally bullish setup. Usually, a rising gold price correlates with a weakening dollar, which aligns perfectly.
It does.
But what happens if a sudden macroeconomic headline drops, right? And the dollar catches a massive bid, defies our bias entirely, and just rips higher across the board? How do we protect the portfolio if the underlying asset simply flips?
That is a great question. And that scenario is exactly why the core philosophy of our New York desk is that we do not predict, we wait for triggers. If the dollar unexpectedly catches a massive bid and rips higher, well, we won't be caught off guard because our invalidation levels are designed to trigger before we ever enter the trades.
The structure protects the capital.
Exactly. Let's look at the math on dollar CAD to illustrate this clearly. The current price is 1.3655.
Okay.
Our base case is a bearish continuation pushing below 1.3666. However, the setup invalidates completely with acceptance above 1.3666.
I see. So the invalidation level acts as an automatic filter.
Precisely.
If the dollar suddenly strengthens and the price crosses up above 1.3666, the structural criteria for our trade simply vanish.
Yeah. Poof, it's gone.
We don't take the trade, and the risk of a macro shock is completely mitigated by the setup's own architecture.
It is identical logic for dollar Swiss. The resistance established during the London session high currently sits at 0.7881. We require a clear, sustained continuation below that level to even consider executing a sell order. And that same precise level, 0.788, serves as our hard invalidation line.
So if the price pushes above it and finds acceptance,
The entire bearish breakdown thesis is structurally broken. We stay completely flat.
this dynamic beautifully highlights the chasm between having a directional bias and possessing an actual operational edge.
It's night and day.
You could spend all morning reading economic reports, and be fundamentally aggressively bearish on the dollar.
Sure.
But if the localized price action crosses your invalidation line, your fundamental bias is utterly irrelevant to your profit and loss statement. The tape always wins.
The take always wins. The market mechanics do not care about a trader's personal bias or, their macro thesis. The algorithms only respect liquidity, volume, and order flow.
Right.
The primary job of an intraday decision maker is to deploy capital exclusively where the structural edge is confirmed by the live tape, not where they assume the price should eventually go.
Read the full final report at alpharoute.vercel.app.
Welcome back. So, knowing when to execute is obviously a critical skill, but transitioning into our observation assets in the Tier 2 and Tier 3 categories, that requires a completely different kind of discipline.
It really does. It's an exercise in patience.
Exactly. If you want to survive as an intraday trader, knowing what not to trade is equally, if not more, important. Protecting your daily capital limit requires you to recognize when the market is offering absolutely no advantage.
Capital preservation is the foundation of longevity in this business, which brings us perfectly to the Dow, or the US 30.
Right.
The profile here today is fascinating from a data perspective. The Dow is currently projecting a massive 96% bearish bias confidence.
96%.
Yeah, huge.
Yeah.
But structurally, it has absolutely no New York operational edge. The protocol generated by the model is strictly weight rotation.
And that disparity between a heavy bias and a lack of operational edge, man, that trips up so many participants.
Constantly.
Let's detail what that Dow rotation actually looks like on the charts right now. It is currently trapped in an intra-range rotation, boxed in between 48,643.2 on the bottom floor and 49,264.3 on the ceiling.
A pretty tight box.
It is. As we look at it now, it is trading right in the middle, around 49,030. When an asset is just pinballing between boundaries and mid-range top like that, stepping into the market is essentially a coin flip.
Exactly.
The 96% bearish bias might sound like a sure thing, but without structural confirmation, it is useless.
Yeah, in our modeling, this is what we call a bias bootstrap in progress.
Okay, explain that.
So the underlying data suggests heavy downward pressure, but the market architecture hasn't actually broken yet to confirm it. And I need to remind our listeners for the third time today, these bias, bootstraps, structural mappings, and support levels are strictly preliminary.
Right, they are just the morning scan.
Exactly. They are currently awaiting final confirmation. You simply cannot trade a 96% bearish bias if the actual market structure is explicitly telling you the asset is stuck in a consolidation box.
And the Dow is definitely not alone in this rotational behavior today.
Not at all.
We're observing that silver, Ethos, and Bitcoin all share this exact same frustrating profile. Incredibly strong directional biases, but zero clear New York edge.
Zero edge.
Take Bitcoin, for example. The models show a nearly 70% bearish bias, indicating a lot of underlying distribution. Yet the price action is aimlessly rotating in a massive 3,000-point range between 74,920 and 77,879.
Yeah, it's just wandering.
The current price is just wandering near 76,080.
And when you encounter that kind of aggressive compression and consolidation, the absolute worst mistake a decision maker can make is trading without an edge.
You just get chopped to pieces.
Death by 1,000 cuts. If you try to force a position in the middle of a massive rotational range like Bitcoin's, The algorithmic flows will just hunt your stops back and forth as price oscillates.
They love that mid-range liquidity.
They feed on it.
Right.
The priority guide for all these rotational assets is identical across the board. Stay in a strict wait mode until valid, undeniable confirmation appears outside those invalidation bands.
Absolutely. Now, to round out the scope of the market, we need to briefly cover the Tier 3 equity indices and the remaining forex majors.
Let's do it.
We are currently tracking the NASDAQ, the S&P 500, the Aussie, the cable, and the Kiwi pairs. And every single one of these instruments is sitting squarely in a weight rotation context.
Yep, all of them.
It is just normal, uninspired market flow today. There is no major expansion, no clear structural advantage, and honestly, no reason to deploy capital.
It is a profoundly sidelined environment for those specific instruments. The volume just isn't there to support active execution.
Right. And to give the intraday traders the exact parameters of this consolidation, the NASDAQ is rotating very tightly between 27,094.5 and 27,403.6.
Going nowhere fast.
Exactly. And the S&P 500 is similarly boxed into a tiny corridor between 7,100.8 and 7,159.2. The prescribed action for all of these indices and the related forex majors is strictly weight.
And, the level of psychological discipline required to handle a day like this is immense.
It really is.
Sitting on your hands and doing nothing while the market is officially open is arguably one of the hardest skills for a developing trader to master.
There is always an urge to click buttons.
Always. But when you look at the S&P 500 boxed into a 50-point range with no alpha direction, executing a trade isn't strategic. It is just volunteering your hard-earned capital to the market makers who feed on that impatience.
You have to treat your daily capital limit like a finite amount of ammunition.
I like that.
You don't just fire blindly into the dark because you hear rustling in the bushes, right? You wait for the target to step clearly into the crosshairs.
Exactly.
Today, the crosshairs are completely focused on our Tier 1 list. Everything else on the board is just noise.
That perfectly frames our closing recap for this session, I think.
Yeah, let's recap.
To distill all the data and structural mechanics down to the essentials, the intraday focus today remains heavily concentrated on the dollar crosses, specifically dollar CAD and dollar Swiss, alongside gold and dollar yen.
Those are the movers.
Right. These are the instruments offering active New York setups, where the structural edges and clear mathematical invalidation levels actually exist.
Yep.
Meanwhile, the broader equity indices and the crypto majors remain completely sidelined, trapped in rotational chop. The key takeaway is simple. Do not force trades where the mathematical edge is absent.
If this briefing helps you, subscribe on YouTube and follow us on Spotify, and share this episode to support the channel. Expanding this community allows us to keep analyzing the tape and bringing you this institutional-grade structural data every single morning.
And a final reminder to all the decision makers on the desk, this is the preliminary briefing. For the final validated 9:00 a.m. report, visit alpharoute.forsell.app. You need to review the finalized data and the confirmed setups before you allocate your risk for the session.
This audio briefing is for educational and informational purposes only and does not constitute financial advice. Always manage your own risk according to your personal parameters. As you head out to face the charts today, ask yourself the hard question. Are you genuinely trading the confirmed structure of the market, or are you just trading your own impatience? Cafe ambience fades out.